U.S. and Chinese officials are hinting there could be a chance to resurrect trade negotiations after President Trump ratcheted up pressure with an additional list of tariffs that would tax over half of all goods they import to the U.S. This latest list is set to go into effect on August 30th. This does give both sides 7 weeks to strike a deal or to dig in. Are the markets pricing this risk in adequately? Our next guest says no, the markets are crazy to ignore the consequences. For more, we welcome now Scott Minerd, Global Chief Investment Officer at Guggenheim. Scott, as always, really great to see you. Why do you think the markets are crazy here? Because it's not, yes, we have seen some of the tariffs actually go into an effect.
Right.
But there is a little bit of time to strike a deal. Yeah,
there is some time to strike a deal, but boy, you know, that tail of risk is just getting fatter and fatter as we go along. And so far, the Chinese have shown no interest in backing down, and neither does Donald Trump. So the likelihood that we're going to strike a deal, I mean, let's just say it's 50-50. I mean, those are some pretty high odds of risk, and the consequences of a trade war would be devastating for both the U.S. and the Chinese economy.
Yes, I hear you on all of those fronts, but there is this view now in Washington, and it's bipartisan as well, that the U.S. needs to stand up to China on trade. And again, Democrats are starting to sound this note as well. There's never really an optimal time to take action. So given the global backdrop, given the strength of the U.S. economy, and it's something that Jay Powell alluded to in his comments earlier today, is the timing for this potential trade conflict, war, tiff, scuffle, however you want to characterize it, is it perhaps good? I mean, there's not a better time to do it, isn't there?
Well, you know, it's sort of like launching a war. Is there ever a good time to launch a war? And the language around this, you know, of a war is an interesting one because wars cost money. And so no matter if it's a good time or a bad time, this comes with a cost attached to it. So my view is that, you know, I would like to see us use other means to apply pressure to China than to use the blunt force of tariffs. And when you look at some of the consequences here, I love to talk about the washing machine tariffs. It's funny, it's such an obscure area, but the washing machine tariffs were announced in January.
Yeah, they've gone into effect.
They've gone into effect. They were 15%. You know, how much of washing machines gone up in price?
15%?
17%. So the reality is who's going to pay for this trade war? It's going to be the U.S. consumer. So when you talk about like tariffs of 25% on automobiles, and some of it, you know, some of it's just content driven. So, you know, maybe it's not going to be a full 25%. Maybe it's going to be 15%. If we were to get a 15% increase in auto prices in the United States, that represents 6% of CPI, which means we would get a 1% surge in the price level. Now, a 1% surge in the price level is going to cause the Federal Reserve to react. And if they decide they have to start leaning against these price increases by picking up the pace of tightening, then it's going to devastate the entire economy. And the strength that you're talking about, Scarlet, today, we may end up very well undermining in this process.
Talk to me about timeline, because the washing machine tariffs have already gone into effect. So we've got some potentially maybe angry people out there who have now had to spend a lot more on washing machines.
Or some dirty clothes.
Right. Or, who are waiting for that new purchase and using the washboard instead. When these other tariffs go into effect, when prices start to rise, one would think there would then be a consumer-led backlash, some political pressure, but how long does it then take to get to the negotiating table? And is the president even susceptible to that kind of pressure?
Well, I think you're asking all the right questions. I'm not so sure that if we get to this point, especially if we view it as an attack on the Chinese, I think that won't go over well in China. And they'll say they have to stand up to the United States. And so this digging in process could go on for years. And, you know, the political backlash, I'm not so sure about. Because I think that, you know, I've met people who tell me that we're going to hurt them more than they're going to hurt us. And I think that's sort of irrational thinking.
Well, if people are being hurt, they're not really caring if the other people are being hurt more. In other words, if the individual U.S. consumer is paying more, do they really care if Chinese consumers are also paying more?
Well, I think there is a hardcore element in this country who might look at this and say, hey, you know what? So I'm paying 15% more for my car. I'm going to make my car last another year or two. But we really have to give it to these Chinese or to these Europeans or these Canadians or whichever one you want to pick.
And I'm really glad you bring up that point because it backs up the idea that the U.S. can win a trade war by other countries losing. It doesn't actually have to win it on its own to come out ahead, right? If others suffer, if our trading partners suffer, then relatively speaking, we've come out ahead. Your take here is that most analysis of the trade situation does not reflect the hard truth of these tariffs being a tax that's paid by the consumer. Why do you think that is? Why are analysts, investors so reluctant to quantify it?
Well, I think one is it's not well understood. Right, we haven't dealt with this issue full scale since the 1930s. And so a lot of the people that were around back then and analyzed the situation and came up with the idea that global tariffs are bad are just not with us anymore. And so we get this very simplistic view, which is, oh, we're only going to put tariffs on 20 billion or 200 billion of assets of trade, and that's only 10%, and that's only $20 billion hit to the economy. And the reality is, no, it's a bigger hit because that spills over into U.S. prices. And ultimately, if it goes on long enough, you start to allocate capital and resources inefficiently. Because if it's easier and more productive to build automobiles in China and to build aircraft in the United States, then there's an advantage here of comparative advantage in trade. And so we want to build the things that we're more efficient at, and we want to let other people build the other stuff. And the basis of trade is that we can raise everybody's living standard. So, I think there's another element too, Scarlet, which is this idea that we're going to declare war on the rest of the world and everybody's going to suffer. Well, something people aren't thinking about is, and it's already happening, if the Chinese reach out to Mexico, they reach out to Europe, they reach out to Canada, we could find that we're the odd man out, that we're the people that are applying tariffs to everybody and everybody else is applying tariffs to us, and that they have uninterrupted or free trade among themselves. And in that case, the U.S. it's not going to be a game of they're losing less than us. It's going to be the U.S. is losing and everybody else is gaining.
So bring it all back then to your view of the U.S. economy, because already when we've spoken to you over the past 6 months or so, you think a recession could happen as soon as next year. Does this even pull that forward? Does it make it a worse recession? What does it do to that scenario?
Well, I think the timing of the recession is pretty well baked. There are things here at the margin that could make it come a little faster or slow it down. So it would obviously increase the risk that the recession comes sooner, but not, I think, to a great extent. However, I think what it will do is it'll cause the Federal Reserve to continue to have to raise rates well past what we would think neutral is. And monetary policy would become restrictive. And because of that restrictive policy, that could force us into a harder recession than we would have had if we hadn't had to lean against the inflation which would come out of tariffs.
And of course, that goes back to Jay Powell, the Fed chair, making comments earlier this afternoon to Marketplace saying the economy is in a good place, but the inflation goal is not fully reached. How far behind the curve does this risk putting the Fed at? He's saying the inflation goal is not fully reached. You're saying we're going to see inflation pick up pretty quickly given these tariffs.
If the tariffs go into effect. I think it's really interesting. I think the pressure would start to appear in the fourth quarter. It would spill over into next year. It would, I think, be a lot more powerful than people think. We just talked about automobiles. It's easy to see how automobiles could add 1% to inflation. But when you've got more goods coming in, you could see a real surge in the inflation rate. And that's going to cause the Federal Reserve to say, you know what, maybe we have to pick up the pace on tightening. And we could see, the Fed funds rate, at maybe something like 3.5%. Somewhere in the middle of next year, certainly by the end of next year, and that is probably well past neutral. I was just with President Williams at the Fed today, and when you look at his own work on the neutral rate, that would suggest the neutral rate today is somewhere around 2.5%. 100 basis points or 1% above the neutral rate would be very restrictive. Think of it in percentage terms. We're talking about a Fed funds rate or an overnight rate that maybe is 40% above what would be neutral. That's a fairly restrictive policy.
And meantime, the Fed will continue unwinding its balance sheet as well, which is another form of tightening.
That's right. And so all of this is coming at the same time. And then the last piece of this is, the tax cuts. People forget that economic growth is a rate of change. It's not an absolute level. So the surge in earnings that we're getting, the surge in growth we're getting is coming because of the tax cuts. But when those tax cuts don't happen again, that growth rate's going to flatten out or probably decline. So at the same time that we're fighting this inflation battle, we may very well find that the economy's losing momentum. And that would be an extremely difficult situation for the Federal Reserve.
Yeah, get those difficult comparisons as a result. Scott Minerd, Guggenheim Global Chief Investment Officer, is sticking with us. Guggenheim striking a deal to acquire Millstein Co. in an effort to bolster its restructuring and liability management practices. The financial terms were not disclosed, but it was announced. Millstein co-founder and CEO Jim Millstein will join as co-chairman of Guggenheim Securities. For more, we are back with Guggenheim Global Chief Investment Officer Scott Minerd. So congratulations on the acquisition. Talk us through how this fits in with your view that we should be preparing for a downturn in the economy. A recession could be forthcoming next year, maybe 2020.
Well, in terms of our firm, it really helps diversify the business mix on the security side. We're currently representing Disney in the acquisition of Fox. We have a lot of great M&A capability, but what happens if I'm right and we ultimately do have a recession? And M&A falls off. And so, being able to do restructuring, the stuff that Jim has really made a name for and his people have made a name is a really great way for us to enhance our business and to reduce the cyclicality in it.
And speaking of which, if indeed we are going to see an economic downturn, how do you grow assets under management in that kind of a scenario? Is it just by being correct on that kind of a point?
Well, you're right. I mean, in the financial crisis where we had foreseen what was coming, we actually were one of the few asset managers that grew assets throughout the crisis. So those times tend to be very good for us. And obviously, the problem you have is you may be growing assets, but the value of those assets may be going down.
Yeah.
So, that's the real challenge and the headwinds. But if you can grow assets through the downturn, once the downturn comes around, then, you'll get a huge surge in AUM, and that's what happened to us in 2009, and hopefully we'll get a replay of it again.
Well, your challenge is to grow assets faster than the value can go down, perhaps. We reported last month that Guggenheim is weighing a stake sale. Talk about who your ideal strategic partner would be to recapitalize the firm, to expand distribution overseas and
Sure.
assets in general.
Well, first off, we don't need recapitalization. So we're not really looking for money, but we have been approached by a number of people who see us as an interesting strategic fit. There's really no discussions going on right now in terms of a particular partner, but it would seem that the type of partner we would want is someone who's going to complement us in other regions of the world, like in distribution, perhaps to pick up some asset management capability in other categories like, sovereign bonds. I mean, believe it or not, people still buy sovereign bonds in Europe. Help me with that. But there are lots of areas where we could further expand our business. And so when people approach us, that's the number one concern we always have, is how they'll fit in terms of our future growth. Not so much, as I mentioned before, we don't need the money.
Okay, if it's for other parts of the world and the partner is indeed foreign, for instance, what would a trade war, or whatever you want to characterize what's going on, how would that affect that?
Well, it's a good question, Scarlet. I mean, there's a lot of uncertainty in the world. Especially when you look at places like China, where the logical next step, if we get into this trade war, is to start capital restrictions. So how do you get a strategic joint venture together with somebody in China? That's a pretty difficult thing if that's what's happening. But hopefully we wouldn't get to that point in Europe. But again, I think at this stage of the game, if the right person came along, we would obviously entertain a discussion regardless of where they are in the world.
And getting back to the idea of competition, your main fund, your total return bond fund, has been performing quite well over the past year and over the 3 and 5 year periods. As you look ahead and look at this sort of recession potential scenario, it seems as though there are an increasing number of other strategists who are maybe coming around to that view. Morgan Stanley, for example, just coming out and saying the curve could invert next year,
right.
and that usually precedes a recession.
Right.
When does that become a risk that everybody's as pessimistic as you are?
Give them about 40 more basis points in the yield curve, right? It's interesting. I really think I'm one of the most boring people in the investment world, because if you talked to me in 2013, I would have told you this. We're doing virtually the same thing today that we were doing then. The only difference was we've upgraded the credit quality of the portfolio. But in 2013, given the shape of the yield curve after the taper tantrum, the clear direction was the curve would flatten from there, and we've had that trade on all along. So the curve between Treasury bills and the 10-year note was 300 basis points or 3%. Today it's a lot lower. I think a lot of people that want to jump on the bandwagon now and capture that last 40 basis points, okay, go for it.
Welcome to the party.
Welcome to the party. We're going to need somebody eventually to take us out of this position. I think that for me, I'm often called a contrarian, which I don't like, because the label implies that I'm trying to have an opinion different to other people. And the reality is that that's not me. I just like to look at the data, look at the world, and see what logical conclusions that I can draw. And it's an uncomfortable place in terms of the pack, because I'm often outside the pack because I don't really listen to them very much. And
it helps being outside of New York, too.
What's that?
It helps being outside of New York.
Though, California's LA's a pretty big bond center.
Yeah.
But the thing I will say is, I've written about this before, is that the consensus is the path to mediocre returns. And so, I'm happy to see people are coming around to our way of seeing the world, and hopefully they'll join us soon so we can get out.
I love how you describe yourself as boring, and then everything that you said after it was not boring.
Scott Minerd, Guggenheim Global Chief Investment Officer, thank you so much for visiting us, and we hope to see you soon again.